So, if you've been anywhere near the internet lately, you've probably seen the headlines swirling around. There's this huge new bill, and everyone's saying it's about to completely change the game for Social Security. But, what's the real story behind all the hype? Well, in this explainer, we are going to dig in. We're going to get to the bottom of how your Social Security is actually taxed, what this new bill really does, and, most importantly, what it means for your retirement.
I mean, you've seen it, right? It's all over social media, it's in news alerts. Maybe you even got a text from your aunt or uncle saying, "Hey, did you hear? No more taxes on Social Security?" And look, it's an exciting thought, isn't it? The idea that this major tax could just, poof, disappear. But as it so often goes with these big, flashy headlines, the reality is, well, it's a lot more complicated. So is that the whole story? Not even close. Let's unpack what's actually going on here.
All right, to really get to the truth, we're going to break this down into 5 key parts. First up, we're going to separate the headline from the reality. What's fact and what's fiction with this new bill? Then we'll decode this new deduction that's causing all the confusion. After that, and this is the big one, we are going to unlock the most important piece of this entire puzzle, the provisional income formula. We'll even roll up our sleeves and run the numbers with a real-world example so you can see it in action. And finally, we'll tie it all together and talk about what this means for your financial strategy moving forward.
Okay, first things first. Let's draw a line in the sand between the myth and the facts. What did this new piece of legislation actually do? Let's be absolutely 100% crystal clear on this. Social Security taxes were not repealed. Not even a little bit. The fundamental, long-standing rules for how your benefits are taxed, they did not change. What the bill actually did was introduce a new, and I cannot stress this enough, a temporary deduction specifically for seniors who are 65 and older. So think of it less like a demolition of the old system and more like, well, like they added a new coat of paint. It's an extra layer on top of the existing system, a layer that, as we're about to see, doesn't even apply to everyone. The core tax rules for Social Security still firmly in place. So we've established it's a deduction, not a repeal. Great. But what does that really mean? Let's get into the nitty-gritty details. Who actually qualifies for this new tax break? How much is it really worth? And maybe most importantly, how long is it even going to stick around? Because the details here, they are absolutely critical. And here it is. This is the number that's causing all the excitement. The bill creates a brand new deduction of up to $12,000 for married couples filing their taxes jointly as long as they're both 65 or older. If you're single, that deduction is $6,000. Now, this is a pretty significant deduction. It applies to your total income, and what's nice is you can take it whether you itemize or just take the standard deduction. But, and you knew there was a but coming, right? This is a huge one. This deduction is not for everyone, not by a long shot. It comes with some pretty strict income limits. The deduction starts to shrink or phase out once your income hits $75,000 for an individual or $150,000 for a couple. And by income, the IRS is talking about something specific called your modified adjusted gross income. Then it disappears completely if you make over $175,000 as an individual or $250,000 as a couple. So what does that mean? It means if you're a higher income retiree, you won't see a single penny of benefit from this. It's really designed to help low to middle income retirees the most. Okay, now we are arriving at the single most important concept for understanding how Social Security is actually taxed. And listen, this has absolutely nothing to do with that new bill we've been talking about. This is the long-standing rule that determines, well, everything, honestly. If you can wrap your head around provisional income, you'll understand how this whole system works.
So what is this magic number, this provisional income? It's a special calculation that the IRS uses for one reason and one reason only, to figure out if your Social Security is taxable. The formula itself is pretty simple. You take all your other income, that's money from pensions, 401k withdrawals, any wages you have, dividends, you even have to include non-taxable interest from municipal bonds, and you add to that number just 1/2 of your total Social Security benefits for the year. That final number you get, that is your provisional income.
And this right here, this brings us to the absolute heart of the matter. Your Social Security benefits aren't really taxed on their own in a vacuum. It's the presence of your other income, the money coming out of your 401k, your IRA, or maybe a part-time job. That's the trigger. That's what can make them taxable. I mean, think about it. If your only income in retirement was from Social Security, you would almost certainly pay 0 federal tax on it. But the second you start adding other income to the mix, this special calculation kicks in, and poof, a portion of your benefits can suddenly be subject to income tax. All right, theory is great, but let's make this real. Let's make it tangible. We are going to walk through a step-by-step example for a retired couple to see exactly how this provisional income formula works in the real world and how it ultimately determines their actual tax situation. Okay, so let's meet our example couple. Together, they get a combined $50,000 a year from Social Security, and on top of that, they withdraw $40,000 from a 401k. Simple enough? So, to find their provisional income, what do? First, we take 1/2 of their Social Security. 50,000 divided by 2 is 25,000. Easy. Then we add their other income, which is that 40,000 from the 401k. So 25,000 plus 40,000 gives us a provisional income of $65,000. Now remember, this number, this $65,000, it's not their taxable income. Not yet. It's just the key we need to unlock the very next step.
Now, what's really fascinating here is that these thresholds you see on the slide, they haven't been changed since the 1990s. They were not touched by the new bill at all. So we take our couple's $65,000 provisional income, and we see where it falls on these tiers. Since they're married, you can see that any income over $44,000 falls into the highest tier. And in that tier, up to 85% of their benefits can become taxable. So let's actually do the math and see what that looks like. So after we work through the different tiers, we find that a total of $23,850 of their Social Security is considered taxable. Now, here's how it all comes together. This taxable portion, the $23,850, gets added back to their other income, that $40,000 from their 401k. That gives them a total income figure before any deductions. It's only at this point that they would apply any deductions they have, including, yes, that new senior deduction we talked about, to finally figure out what their tax bill is.
Okay, so now that we understand the rules, we understand the math, let's talk strategy. How can you actually use this information to your advantage? Because this is where the real power is. First, and if you take away only one thing from this, let it be this. The new senior deduction is temporary. As the law is written today, it starts in 2025 and it is set to expire at the end of 2028. It's gone. This creates a very specific 4-year window of opportunity. For your own planning, you should absolutely assume that it will disappear after that. This makes the next few years a really unique and potentially valuable time for strategic retirement income planning. So let's just quickly summarize the big takeaways here. First, this new deduction, it primarily helps middle-income retirees. Second, the core system for taxing benefits, that whole provisional income thing, hasn't changed at all. So what can you do? Well, this temporary deduction creates an interesting window of opportunity. For instance, it could help offset the taxes on a Roth conversion, which might let you move money from a pre-tax account, like a 401k, into a tax-free Roth IRA more cheaply than you could before. Or you could look at ways to lower your income to try and stay under those phase-out thresholds, maybe by using qualified charitable distributions directly from your IRA if you're over 70 and a half. That can satisfy your required minimum distribution without adding a dime to your income.
And all of this brings us to our final question for you. The headlines were pretty misleading, yeah, but the reality presents a real, even if temporary, planning opportunity. Now that you know this deduction exists for a limited time and you understand that provisional income is the real key to your tax bill, how might you adjust your own strategy? Does this make you want to accelerate withdrawals, maybe defer them? The rules are on the table and the clock is definitely ticking. How are you going to play the game?